5 minutes was all it took for the ground to shift. Canada's announcement of China-linked deals did not land as a routine economic development. It collided directly with the assumption that Ottawa's alignment was predictable, stable, and anchored to Washington's strategic orbit. The timing created something Washington has long tried to avoid: the appearance that Beijing can move faster, offer more, and exploit hesitation inside North America's closest partnership. What unsettled observers wasn't the content of the deals themselves, but the speed with which they appeared after months of public tension, suggesting a recalibration that had been forming quietly beneath the surface. Canada framed the agreements as pragmatic responses to economic pressure, but the sequencing told a different story. Sensitive sectors previously insulated from foreign leverage were suddenly open to negotiated influence at a moment when Ottawa's fiscal constraints were widening. Each concession looked minor on paper, yet the aggregate signal was unmistakable. China had found an entry point that didn't require confrontation, only timing and persistent engagement. When a country under pressure accepts conditions it once rejected, the world notices, and so do its closest allies. Washington's reaction exposed how unprepared it was for such a rapid pivot. For years, US policymakers interpreted Canada's caution toward Beijing as structural, not situational. That assumption created a blind spot. They expected any change to unfold slowly, with extensive debate, clear warning signs, and alignment with American priorities. Instead, Canada shifted when the US was preoccupied with its own economic strain and political fragmentation. A window opened, and Beijing stepped through it before Washington recognized the opportunity had even formed. At the domestic level, Canadians were left wondering how an alliance celebrated as unbreakable could produce such divergent strategies under pressure. Industries facing labor shortages welcomed new capital. Innovation sectors saw access to scale. Yet civil society groups warned that the pace of engagement reduced transparency and limited institutional oversight. Each benefit carried an unspoken cost, and the public had no clarity on how those trade offs were calculated. The deeper consequence is what remains unaddressed. If these deals mark a strategic adaptation, then Ottawa may be signaling a broader shift in how it balances risk, no longer assuming Washington can always stabilize the environment. But if the deals reflect diminishing US leverage, the implications extend well beyond Canada. In either case, the question that now hangs over North America is the same. What happens when an ally moves first and moves toward a rival before Washington has defined its own position? Long before the public announcement, the groundwork had already been laid through a pattern of Chinese capital flows that rarely triggered headlines, but steadily altered the balance of influence. These were not sudden injections of money, they were quiet, layered commitments spread across strategic sectors that Canada depends on to stabilize growth. Energy infrastructure, critical minerals, advanced manufacturing, and emerging technology ecosystems all saw incremental participation from Chinese state-linked firms. None of these investments looked dominant on their own, yet each one created a point of leverage that could be exercised later with little friction. By the time the new deals surfaced, the financial architecture supporting them was already embedded deep enough that reversing course would carry real economic cost. Canada treated these inflows as pragmatic tools to offset structural vulnerabilities: labor shortages, rising capital costs, and stalled private sector investment. Provincial governments welcomed partnerships that promised immediate job creation. Municipal councils approved projects that expanded their tax base. Innovation hubs saw access to financing they could not secure domestically. At every institutional level, the incentive was to accept support that arrived quickly and without the procedural delays attached to North American or European funding. Yet speed came with trade-offs, and none of them were fully acknowledged. With each agreement, China positioned itself not simply as a market participant, but as a recurring source of capital Canadian industries came to rely on. Washington understood the numbers but missed the trajectory. For years, US officials believed that regulatory scrutiny and national security reviews would prevent Beijing from gaining meaningful footholds in Canada's economic infrastructure. Instead, they watched influence disperse across dozens of small, technically compliant transactions that collectively shifted power without triggering intervention. By the time US policymakers realized the scale of interdependence forming beneath them, the question was no longer whether China had influence, but how deeply it could shape the rhythm of Canadian decision making. Beneath this financial network lies a more uncomfortable reality. Once a sector adapts to foreign capital as a stabilizing force, it becomes structurally bound to the conditions that capital sets. Industries begin planning around it, workers build expectations on it, governments rely on it to meet growth targets. Pulling back becomes costly, yet moving forward requires concessions that accumulate quietly. Canada now sits inside that tension, where the benefits of continued engagement are immediate and the risks of resistance grow heavier with each passing quarter. The unresolved question is whether Ottawa still defines the boundaries of this relationship or whether Beijing's steady, patient investment strategy has already shifted control of the timeline. And if the pace of engagement is no longer Canada's to set, the consequences will not remain confined to economics or to Canada alone. Washington assumed proximity, guaranteed alignment. For decades, US policymakers believed Canada's strategic incentives were fixed, predictable, and ultimately dependent on American economic gravity. That confidence created a blind spot. As Canada's pressures deepened, slower growth, rising operating costs, fractured supply chains, Washington misread necessity as loyalty and failed to recognize that Ottawa's calculus was shifting from preference to survival. In that space between assumption and reality, a strategic vacuum opened wide enough for Beijing to operate without direct confrontation, simply by offering what Washington could not deliver quickly: capital, market access, and immediate relief instead of procedural promises. The United States interpreted Canada's caution toward China as a permanent stance rather than a conditional one. This miscalculation allowed small policy gaps to widen into structural openings. Trade negotiations stalled while Canadian exporters sought alternative markets. Regulatory delays mounted while Chinese financing moved with fewer constraints. US officials insisted on long-term security alignment while Canadian industries faced short-term risks they could no longer absorb without external help. The mismatch of timelines, not values, became the source of divergence, and Washington did not adjust its strategy to close that gap. As a result, every step the US takes now carries a higher cost. Reasserting influence requires more than diplomatic pressure. It demands economic alternatives that Washington is not ready to provide at scale. Attempting to slow Chinese participation risks destabilizing Canadian sectors already reliant on it. Remaining passive risks deeper entrenchment. Meanwhile, industries on both sides of the border are recalibrating based on new expectations. Canadian firms planning around diversified partnerships, American companies preparing for less privileged access, and policymakers trying to stabilize an arrangement that no longer reflects the economic truths shaping decisions on the ground. The most uncomfortable consequence is that Washington's remaining tools, sanctions, investment reviews, trade leverage, may not restore alignment. They may accelerate the very realignment US officials want to prevent. Each action intended to demonstrate strength could deepen Canada's perception that the United States cannot offer the certainty its economy now requires. If that perception cements, the question will no longer be whether Washington can regain influence, but whether the window to do so has already closed. Canada's recalibration did not begin with a geopolitical ambition. It began with pressure accumulating inside the country's economic core. Years of rising costs, stagnant productivity, labor shortages, and tightening fiscal space forced policymakers to confront a reality they could no longer push forward with incremental adjustments. Critical sectors, manufacturing, clean energy, transportation, and resource extraction, needed capital at a scale domestic investors could not meet. Provinces demanded faster approvals to revive stalled projects. Municipalities faced infrastructure backlogs that restricted growth. Businesses warned that without new financing and expanded export routes, they would lose competitiveness in markets they once dominated. These pressures converged into a single imperative: adapt or accept decline. Beijing understood this dynamic before many in Ottawa fully articulated it. Chinese institutions offered capital with fewer procedural delays, access to supply chains that Canada depended on, and market entry pathways that the United States had deprioritized. To a government constrained by domestic expectations and slowing economic momentum, these offers arrived at the exact moment traditional partners were unable or unwilling to move with comparable speed. What appeared publicly as opportunism was, in reality, the product of careful observation of Canada's structural vulnerabilities. When a state faces simultaneous internal demands and international uncertainty, timing becomes leverage, and China used it with precision. Inside Canada, the decision making process reflected the tension between long standing alliance commitments and immediate economic needs. Cabinet ministries evaluated the deals through the lens of job preservation and regional stability. Provincial leaders viewed them as lifelines for industries at risk of contraction. Business coalitions pushed for partnerships that could stabilize costs in a volatile global market. Each institution acted rationally inside its own constraints, yet collectively, those choices nudged the country toward reliance on a partner that operates with different strategic assumptions and a fundamentally different interpretation of interdependence. The public felt the shift in subtler ways: fluctuating prices, inconsistent supply chains, and uncertainty about which direction the economy was actually moving. Trust in economic governance depends on the belief that decisions are made from strength, not necessity. As Canada engaged with China more deeply, that distinction became less clear. The pressure to demonstrate economic resilience clashed with the fear of exposing the country to new forms of dependency. Whether Ottawa recognized it or simply responded to momentum remains unclear, but the pace of engagement suggests a trajectory shaped less by choice than by urgency. And if urgency is now driving strategy, the question becomes what other compromises may emerge before Canada fully understands the path it has already entered. Beijing's call for a reset sounded conciliatory, but the substance behind it carried none of the softness implied by the language. China did not approach Canada with an offer to restore the previous equilibrium. It approached with the expectation that the balance of influence had already shifted. In Beijing's framing, a reset was not a return to normal. It was an opportunity to redefine the terms of engagement in a way that permanently reflected Canada's growing dependence on Chinese capital, markets, and supply chain access. Every gesture of goodwill was paired with an implicit reminder of what Canada now risked losing if it hesitated: investment in critical sectors, preferential treatment in trade flows, and insulation from the volatility reshaping global demand. What made the offer so strategic was its timing. Beijing understood that Canada's options had narrowed, not because of ideological misalignment with Washington, but because the economic landscape left Ottawa with fewer viable alternatives. Chinese officials emphasized cooperation and mutual benefit, yet the underlying structure of the reset required Canada to accept deeper integration into frameworks designed and dominated by Beijing. These frameworks do not operate on equal footing. They reward compliance, discourage resistance, and rely on the slow accumulation of influence across regulatory systems, industrial policy, and long-term infrastructure planning. Canada could access new opportunities, but only by entering an architecture where China defines the pace, the priorities, and the acceptable boundaries of disagreement. Institutionally, the implications extended far beyond trade. Canadian regulators faced pressure to harmonize standards to maintain market access. Universities and research hubs confronted new expectations around intellectual property coordination. Provincial governments evaluating joint ventures encountered partnership models that embedded Chinese oversight into local decision-making processes. Each layer appeared manageable in isolation, yet collectively they pointed toward a restructuring of authority that Canada did not fully design. Beijing's strategy relied on this dispersion of concessions, small enough to avoid political collapse, significant enough to shift power over time. For ordinary Canadians, the consequences surfaced in less visible ways. Industries recalibrating supply chains around Chinese preferences, workers retraining for sectors shaped by foreign investment strategies, and communities adapting to infrastructure decisions influenced by partners with different political incentives. The more these adjustments accumulated, the harder it became for Ottawa to reverse direction without triggering economic shock. That dependency is not accidental. It is the mechanism through which Beijing converts partnership into leverage. What remains unresolved is whether Canada can participate in this reset without destabilizing its own institutions. Accepting Beijing's terms promises immediate stability but risks ceding strategic space. Rejecting them preserves autonomy but threatens sectors already stretched thin. And as those pressures intensify, the question is no longer what Beijing demands. It is whether Canada can afford to refuse or whether the cost of hesitation will reveal just how much influence has already shifted. Canada's trajectory reached a point where individual choices no longer stood alone. Economic reliance, diplomatic recalibration, and emerging security dependencies began reinforcing one another, creating a momentum that no single institution could slow without triggering consequences elsewhere. Industries that had adapted their operations around Chinese capital warned that any abrupt shift would collapse investment cycles already in motion. Provinces tied to joint ventures signaled that withdrawing would jeopardize thousands of jobs and destabilize local budgets. And federal agencies, aware of the geopolitical implications, found themselves constrained by the very economic lifelines they had once viewed as temporary tools. Each sector locked the others into a direction that was becoming harder to reverse with every passing quarter. Diplomatically, Canada discovered that adjusting its relationship with China demanded more than a change in rhetoric. Access to key markets came with expectations, predictable regulatory treatment, long-term concessions in trade frameworks, and the quiet accommodation of Beijing's sensitivities. These expectations were not issued as ultimatums. They accumulated through repeated interactions that made deviation increasingly visible and increasingly costly. Any attempt to restore distance risked retaliatory responses calibrated to apply pressure without provoking international backlash. Ottawa had to weigh each step not only for its immediate effect, but for the cascading reactions it could unleash across trade, investment, and bilateral cooperation. Security considerations added another layer of complexity. Supply chains for critical minerals, battery production, and essential medical components were now partially rooted in Chinese-controlled networks. Emergency stockpile managers and defense planners began internal assessments showing how difficult it would be to unwind these dependencies in the short term. The public never saw the full scope of these assessments, but policymakers understood the implications. Strategic autonomy was narrowing, and the timeline to restore it was lengthening. Reversing course too quickly could expose vulnerabilities that had quietly accumulated under the surface of normal economic activity. As these pressures converged, Canada approached a threshold where the cost of changing direction exceeded the cost of continuing forward. Not because forward was safer, but because backward was no longer feasible without political upheaval, economic disruption, or diplomatic rupture. The country was being carried by momentum shaped not by one decision, but by dozens of interlocking commitments that made hesitation dangerous and reversal destabilizing. What remained unresolved was how Washington would react to this new reality. Any intervention to pull Canada back into closer alignment risked widening the fissure already forming inside the North American partnership. Yet, doing nothing allowed the momentum to accelerate unchecked. The uncomfortable question, now impossible to ignore, is whether the United States can act without deepening the very break in regional cohesion it is trying to prevent. Beneath the public statements and diplomatic positioning, a harder architecture has already taken shape, one that operates independent of political mood or shifting rhetoric. Financial interlocks built through years of incremental partnerships now tie Canadian industries to supply chains, credit channels, and investment cycles that originate in Beijing. These links do not disappear when tensions rise. They persist because entire sectors have structured their forecasts, staffing, and long-term planning around them. Trade realignments, once framed as temporary hedges, have matured into durable patterns of exchange. Canadian exporters adjusted their logistics to serve markets where demand is steadier, even if the strategic implications are far more complex. At the same time, Chinese firms embedded themselves inside procurement networks that provinces and municipalities rely on to meet timelines and control costs. None of this can be unwound without exposing vulnerabilities that have quietly accumulated beneath the surface. Geopolitical incentives reinforce these structural ties. China sees stability in deepening Canada's reliance, while Canada sees short-term security and diversified partnerships that reduce immediate shock risk. For Beijing, every investment creates another point of leverage. For Ottawa, every dependency becomes another constraint that limits how sharply it can reorient in response to global pressure. These incentives intersect in ways that neither government can fully control. Commitments made for economic reasons carry national security implications. Decisions framed as strategic hedging reshape diplomatic expectations. Domestic policy choices alter the balance of power across North America. The architecture is no longer flexible. It has weight, rhythm, and inertia. On the ground, the consequences emerge slowly but unmistakably. Companies adapt hiring practices to match supply chain demands shaped abroad. Workers retrain for industries increasingly intertwined with external partners. Regulators find themselves negotiating standards that must satisfy actors outside Canada's political system. Even public expectations shift as communities grow accustomed to infrastructure projects, business expansions, and employment cycles linked to foreign capital. These adjustments feel normal in the moment, but cumulatively, they lock the country into a direction that cannot be reversed without significant economic and political fallout. Washington faces the same structural reality from the opposite angle. Its influence rests on assumptions that no longer align with the architecture forming beneath it. Reasserting control requires untangling networks that have already stabilized. Ignoring them risks accelerating a drift it can no longer claim as temporary. Yet every tool it considers, trade pressure, regulatory scrutiny, security alignment, carries the possibility of intensifying rather than containing the divergence. What remains concealed is the timeline. The real consequences of this new structure will surface not in the announcements that draw headlines, but in the fracture points that emerge when external shocks test whether these intertwined systems can withstand stress. Those shocks have not arrived yet. But the pressures building inside this rigid architecture guarantee that when they do, the break will reveal how little room either side has left to maneuver, and how much of the outcome is already baked into the structure they helped create.